A growing trend that's all the rage in the ETF business, and that's factor investing. This is simply building portfolios using indexes based on something other than market capitalization. But do they actually outperform? Goldman Sachs seems to think so. Their suite of active beta ETF takes 4 different factors: value, quality, momentum, and low volatility, and then combines them in various ways into a very low-cost ETF, only 9 basis points. That's SPY's level right now. Their largest fund, the active beta large cap, it's got Microsoft in it, Apple, Amazon, Facebook, they're the largest components, but it's got a relatively low weighting. The top 10, for example, holdings here only make up 17%. Steve Sachs joins us now. He's head of capital markets for ETFs at Goldman Sachs Asset Management. Congratulations. Good to see you again.
Bob, it's always good to see you.
It's, I think, interesting that Goldman decided to approach the whole ETF business in a slightly different way. Rather than let's create a suite of plain vanilla ETFs and utilize our existing investment base and bring them in, they brought you in, they created a series of factor ETFs and got a really low price on that. 9 basis points is pretty low, and you've been successful. You've got some significant assets under management.
We do. In fact, we just hit $12 billion in assets this week across our ETF suite, which is now a total of 18 products. As you mentioned, our flagship suite is really the active beta suite, consists of 6 strategies, GSLC being our flagship fund. That fund alone is approaching $5 billion in assets. So to your point, what we really saw at Goldman was not getting into the ETF space because that's the thing to do these days. We actually had these strategies existing inside Goldman for a number of years. In fact, the active beta strategies have a significant amount of institutional assets benchmarked to them in separate account form. Our institutional clients and our advisor clients were coming to us and asking us, can you deliver these strategies in an ETF wrapper? Going back to the conversation that you gentlemen were having earlier, that's all an ETF is, right? It's just a delivery mechanism. No. It's not a separate business. It's delivering investment strategies through the ETF wrapper.
I guess the problem I have is I completely agree with everyone who says God did not say thou shalt invest only in market cap weighted, investments or indexes, and yet intellectually, market cap weighted makes the most sense. It certainly makes more sense than price weighted indexes that we all know and love, and yet. Is there enough of an investment history to show that factor weighted, and specifically the ones that you're talking about here, value, quality, momentum, low volatility, actually outperforms at all?
Yeah, we think so. Certainly when you look at GSLC, since inception, and certainly if you look at the last year, GSLC actually outperformed 80% of all of the mutual funds and ETFs out there in the large blend category. And the idea behind active beta, which is just our brand name for smart beta, to your point, it's 4 factors. It's equally weighting those factors in a portfolio. And the idea is this, right? At the end of the day, the hardest part of the puzzle is the asset allocation. Security selection becomes a very challenging exercise, particularly in U.S. large cap, right? When you think about what active managers are exposed to, though, at the security level, they're exposed to value and quality and momentum and low volatility.
It's certainly been around a long time, Dan Weiner. You've got $5 billion in assets under management. What do you tell clients when they ask you about factoring and active beta?
Well, first of all, Vanguard got into this business a year ago, right? And to be able to determine which factor you want to emphasize, and they're in the same business, the value and the quality and the momentum and the minimum volatility. And if you look at the performance month to month, quarter to quarter, it's all over the map. Of the 5 or 6 different factor ETFs that Vanguard's come up with, the 2 with the most money have been the 2 worst performers since inception. Yeah. I mean, you really can't. And factors is, I hate to be the cynic on the show here, but factors is just another the fancy way of saying we're gonna slice the bologna a little different.
He's right. It's been around a long time. I mean, value investing. How old is that? And that's a factor here that's waiting. So what I notice is, depending on how you slice and dice it, if you just use one of them, you can get an outperformance at certain times, and if you combine them all, you can get a certain outperformance. But do you get any long term? Is there a compelling case to go to the average investor and say, yes, you should consider this?
Well, I think there is, and you mentioned long term. There is factor chasing that goes on, and we can tell just by the flows. People buy the wrong factors at the wrong times. However, if you look back when early factor investing in the ETF space was really getting hot, it was pre-financial crisis. And through 07 to 09, those factor strategies did quite well compared to capital market weighting. So we really are in a situation where those that are looking at factors are doing it because they want a defensive strategy. They feel the market might be a little bit long in the tooth. And if we see a major correction going forward.
And how do you sell this, Steve?
Yeah,
how do you go out and tell people, like, you need this as X part of your portfolio? What kind of investor? How is this? Who's buying this?
So you guys are actually making our point for us from the active beta perspective, right? When you think about GSLC, GEM, which is our emerging markets fund, all the same strategy. It's the reason we use 4 factors, and it's the reason we combine them in the way that they do, right? We would actually argue with you guys. We think single factor investing is very, very difficult. Very hard to time factors, very hard to pick which one is going to be in favor this year. When you combine 4 factors like the ones that we do, they actually have a very low, or even in most cases, very negatively correlated relationship to each other, which again, the idea is to give a better risk-adjusted return. It's also all about tracking error. And what do I mean by that? It's the amount of risk you're taking versus the S&P 500 or the cap-weighted benchmark. Yeah. The idea with multi-factor investing should really be to take a small amount of tracking error to give yourself a much better risk-adjusted return, not making outsized bets, particularly in things like low vol, which can actually go against you, strangely.
We got to go, but my point here is, you've actually, GSLM has performed pretty close to the S&P 500. Was that intentional? Does that?
It is. GSLC and the entire active beta suite by design targets a relatively low tracking error, about 2% from its original calibration at design. And that's on purpose. The idea is to let these factors work smoothly together in a better risk-adjusted
10 seconds.
fashion.
I was just going to say, people have been using factors for decades. Small cap value,
Factor,
mid cap growth.
Yeah.
They're all factors.
Absolutely.
Thanks, guys. This does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Steve, Dan, and Tom, all friends, for joining us today. And thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday, same time, same place. Have a good week.